Dear all, we will start this month a Moody's market review in a different way. The crisis in Ukraine is a dramatic event for human lives and may have important consequences for the global economy and financial markets. The most severe scenario we had in our radar unfortunately materialized with Russia invading Ukraine overnight on February the 24th. This immediately put pressure on global risk assets, but we didn't see panic selling. On the contrary, US equities eventually reverted their losses in the closing of the first day of the war. The escalation in geopolitical tensions between Russia and Ukraine adds uncertainty to the global outlook, and at the same time, central banks are acting to fight inflation pressures. In February, central banks were the most influential market driver. They announced that the easy monetary policy markets got used to is coming to an end, as they will hike rates and reduce progressively liquidity in the financial system. In our opinion, markets overreacted to central banks' announcements, risky assets ended the month in red, spread and peripheral spreads widened, and the performance of risk assets reverted the upward trend on interest rates. In February, the consumer price index print came in again higher than expecting, stoking fears for inflation remaining higher for longer, as we are convinced it will be the case. Following a series of strong inflation and activity data, the bond market was starting to price in more hawkish central banks' decisions. However, government bonds rallied afterwards because of the tension in Ukraine. Currencies surprisingly remained almost stable during the month, while the US dollar, the Japanese yen, and the Swiss franc appreciated more recently as the war started. Energy prices lifted, with Brent crude oil rising above $100 per barrel, even ahead of the start of the military conflict. The recent news flows report that supply responses will come from Saudi and Iran oil producers. In our view, this partly removed the risk premium from oil prices and will help to contain the price of Brent crude in the forthcoming month. This is especially important in Europe, where energy prices were the most influential factor in inflation dynamics. Gold went up and reached $1,900 per ounce as investors are looking for safe haven assets. The US dollar, Swiss franc, and Japanese yen moved in the same direction. In our stance, the Russia-Ukraine conflict is having an impact primarily on confidence and commodity prices in an already inflationary environment. As I said, the current situation could have key impacts on inflation and energy prices and may prolong the supply chain disruption. The risk of stagflation globally is now higher as the inflation factor gets reinforced while the growth factor weakens, although China is relatively insulated from this. From a market perspective, we are convinced we are not out of the wood yet, and we will see more negative headlines over the coming days. We keep hedges in places and stay cautious. We recommend not to overreact to the excesses that we will likely see in the coming days. We are confident that some duration, gold, and safe haven currencies will help to protect portfolios. Equity, that are very liquid asset class, should be the first target of risk reduction for market, and credit will likely follow. Overall, keeping cash buffers and a high focus on liquidity should be key. We are not keen to trade on geopolitical guesses at this stage, and we are avoiding to buy on current dips. It is too soon to judge medium-term macro impact. We wait for a less uncertain macro view on the conflict and more clarity on stimulus exits from central banks to start reaccumulating progressively and selectively risk exposure. Thank you for listening. Please keep safe and see you next month for another market review.
TMB และธนาชาติเปลี่ยนเป็น TTB เปลี่ยนเพื่อให้ชีวิตคุณดีขึ้น